Welcome everyone to the E4 Carolinas Digital Technology webinar. This is one in a series of webinars we conduct on the topic, and we're very pleased to have SIA Partners as the sponsor for this again this year, and our appreciation to them for helping make this happen. I'm John Morrison. I'm the President and CEO of E4 Carolinas. Thank you. I now want to introduce Shane Williams from SIA Partners, our sponsor here. He's going to tell you about the program, about SIA Partners, and what we have in store for us today. So Shane, take it away.
Thank you, John, and thank you, E4 Carolinas, for allowing us to be here with you today and sponsor this very exciting webinar. We've been working with E4 Carolinas now for a few years, and since last year and the year before, working directly on developing this webinar series around technology that enables energy. One of the things I want to bring to you about SIA Partners is that we're a management consulting firm. We're headquartered in Paris, France. So we're global. We have about 2,500 consultants around the world, 38 locations in 18 countries, and have energy as one of our top practices that we engage in. Today we have strategy, people, process, and technology as our sort of four pillars in the energy space that we engage in. In strategy, we typically are working on benchmarking surveys, doing assessments, commercial strategy, prioritization for clients. On the people side, we will focus on program and project management. We tend to focus on change management, and sometimes where needed, some clients do ask us to come in and help with some staff augmentation. Around process, we do a lot of documentation, performance improvement, and process transformation. And on the technology side, focus in on enterprise automation. We do have a very sizable data science team of about 250 plus data scientists. And on the technology side, we tend to focus more on migrations as well when we're helping clients with reorgs or process improvements, enterprise-wide initiatives, data migrations, and the like. Before I go on, I just want to thank E4 Carolinas again for helping us to sponsor this event. With that said, I will introduce Justine, who's going to take over from here and present the panelists and talk a little bit about the webinar coming up today. Thank you very much.
Good afternoon, everyone. I'm Justine Koch. Shane, all the names are hard to pronounce, so I'm going to say like the drink. And anyway, thank you. And there's a lot of names here that if you would switch to the next slide. Okay, so you'll see we have some names here that I'm not going to try to pronounce, so I'll let them do it. But I lead our energy practice, which is primarily power and utilities and oil and gas here in Houston. So the folks from SIA that you see here are in that practice. Energy of the future, broad topic. What does it really mean? We brainstormed to think it through with E4 Carolinas, and we landed on these topics right here. So we have three basically separate topics we're going to talk about. We've shortened this, the format of the webinar used to be a little bit longer, so it's an hour now. I'll give a very brief introduction and give you the overview of what they're going to talk about just briefly. And then when they get to their presentation, they can talk a little bit more about themselves and what they're going to talk about. Each of them has a set of slides they'll be going through and open discussion. After that, there will be a Q&A, and we've left enough time for that. If you do have questions, put them in the chat. We're monitoring the chat. John, everybody from E4, Shane, myself, we're all monitoring that chat there. And then lastly, I want to say from our perspective, SIA, we're always interested in your feedback. We have broad topics here this year. We've set some topics out for the next 3 quarters. Obviously, everything's going to change within the next, couple of weeks, so that's always moving. But any feedback that you can give John or I or anyone on that you see here on SIA or for E4 would be great. So our first presenter is Alain, and he is going to talk to you about power and energy trading. And I have to give full disclosure, we've worked with him in the past, so we know his expertise, and we are thankful and excited to have him here. So welcome. Kieran is also going to talk. He's our second speaker. He's going to talk about blockchain. So some expertise there. We also know that's a hot topic. And Justine, who is with SIA, one of our colleagues, will be talking about crypto. We've worked with her on crypto, always a topic of interest to everyone. And then Jean-Christophe, or JC, he will be joining the panelist section, the Q&A section. And he is going to also talk about blockchain, starting up some blockchain for LNG. So those are our panelists. I'll let them, our speakers, and then JC is one of the panelists. I will let them talk a little bit more about themselves and how they fit into overall energy of the future. I think you'll find it interesting. And again, feedback would be great. So I think next slide, Joe and Alain, you'll start for us.
All right, thanks guys for having me here. And I'm secretly suspecting that I'm the icebreaker because I'm Canadian, but I don't know if I'll ever get the proof of that at some point. So happy to be here. My topic today is going to be the natural evolution of an asset management function for renewable asset. My name is Alain Brisebois. I'm president of CWP Energy, and we are an electricity trading and asset management service company based in Montreal. You can go to the next slide, please. Basically, we started in 2012, and we originally were founded as physical trading of electricity out of Montreal, and we quickly evolved into nodal trading all across the North American footprint. So we do everything from virtual congestion, financial, and asset management on behalf of customers in Canada, US, and Mexico. We got to where we are today because we were generally dissatisfied with the offering of products out there to deal with energy markets. And we had to also develop our own ways of doing things because we felt like the direction of the market was going in a total different direction than what's been done since many years. So we had to build our whole platform ourselves, from trading to trade submission to database to decision making. So we were able to build a significant database where we also have a platform where we do automatic and systematic decision making. So that allows us to properly support trading personnel and service customers in a way that is scalable given the sheer amount of data that we need to handle now with energy markets. So that led us also to build an extensive expertise around the intermittency of the grid and the congestion that's being induced by renewable assets. So I'm going to quickly flip to the next one, please, and we're going to go through the changing landscape. I don't think I need to convince you guys that we're experiencing a huge change in the risk and renewable landscape. We've seen it. There's a steady decline in wholesale electricity prices on average year over year. You also have that situation that's making it a lot more difficult to sign long-term offtakes for these assets. So it's changing, it's shortening a lot the tenors at which people are willing to commit to buying energy, given that we're in a declining price environment. Technology costs are also going down significantly, and there's a lot of capital deployment mandates out there that's really fueling the deployment of renewable energy out there. We are also seeing difference in risk appetites in different stakeholders in this industry. You get project sponsors that are getting a lot more risk on, where tax equity is really sitting on a risk averse position, and it's changing how people are thinking about financing those projects. And we've also seen with corporate PPAs, a lot of fixed shape PPAs hit the market, and it created different risks that people are seeing and having to manage right now. We've seen an increasing number of volumetric risk situation that needed to be mitigated, and also on a basis. Those risks has been there before, but they have been less scrutinized because the intermittency was not as intense as it is right now. So people now need to take control of that and manage it actively. So if we go to the next slide, I'm going to give you a concrete example of volumetric risk problem. If you look at the blue line, is a typical like fixed shape, fixed price offtake, where the asset owner pre-sells all his generation at a fixed price and a fixed volume for the future. And they're happy with that because they say, hey, we're smart, we are kind of canning the revenues, everything's going to be stable for us, and we're not going to have any price risk on our balance sheet. Because they do it at the P99 level most of the time, they think that on average, 99% of their production is going to be enough to cover for this commitment, which is not wrong. But if you break it down at the hourly level, you can have hours where your commitment to sell is a lot more volume. The volume that you're committed is a lot bigger than what you're actually generating. And if you go back to last year in Texas with Winter Storm Uri, a lot of people learned it the wrong way, where they were forced to buy the energy that they weren't generating to fulfill their commitment. And they had to buy it at market prices that were sitting at the cap for multiple hours/days. So you're not a happy camper when that happens, and you really need to be conscious of the risk you're actually taking. It's not a risk-free scenario if you contract your generation forward with a fixed shape and a fixed price. So people have also been experiencing basis risk, where the basis is most of the price certainty products are executed at the busbar level, and it's a different settlement point from where you actually generate and inject the energy onto the grid. So you're subject and responsible as an asset owner for that spread between your injection node and your settlement node. So we've seen a lot of that basis risk mitigation requests out there for us. So given all those changes, we think that the way to deal with this is to actively manage your fleet of assets. And you need to be aware of your real exposure. And in order to do that, you need to challenge a bit how things have been done since the onset of those assets. So if you flip the next slide, traditional asset management hasn't been very complex, and the puzzle for getting these assets on the grid has been pretty simple, where you want to build an asset. You find a tax equity partner, they put a bit of the capital there. You sign a long-term offtake where you fix your price going forward. You get debt, and then you get the asset built and on the grid. You find an asset manager that's going to deliver your energy on a daily basis, and you live a happy life. So you kind of have a false sense of security there, as I mentioned before, because you have this lingering volumetric and basis risk that's in your project that you don't necessarily see if prices are low and stable. But as soon as you start to see volatility, and the more and more that the grid is becoming intermittent, you're going to see a lot more of that volatility and localized congestion that's being induced by renewables. So it's creating this weird situation where the people handling your asset is not incentivized to make daily decision in order to mitigate what's going on a daily basis. So that's one of the issue with traditional asset management. And I was talking a little bit about tax equity partners a little earlier. As much as they did well to foster renewable growth on the grid, they created this silo ecosystem where one project is linked with one equity partner that is linked with a company. So the project sponsor can have multiple projects that are siloed off from one another. And all individual projects have their own objective. They have all their own risk aversion. And it creates this spider web of risky asset that you thought that were risk-free, but now that you're having to handle like one-off conversation with all your partners individually. So traditional asset management addresses project-specific risk with one solution. So whether it's price certainty, basis hedge, or even keeping it merchant sometimes, but it doesn't really actively make a decision on how to mitigate market conditions. And they passively deliver the energy onto the market. At CWP Energy, we want to challenge that model. And if you flip to the next slide, what we're suggesting is that the asset manager's job is to make daily decisions to mitigate expected market conditions and protect the project IRR. And that goes well beyond the traditional scope of asset management. And if I had to make one shocking declaration in this webinar, it'll be this one. I think the days of fixed fee passive energy managers are counted. I think the days where they can avoid being accountable for the performance of the assets are counted as well. I think they need to own that market function and be responsible for the project profitability if they are going to operate them on a market on a daily basis. If you flip to the next slide, I wouldn't be here if I didn't have a solution for that, obviously. The solutions we're suggesting is to get an active asset management function created where sponsors can aggregate their exposure and manage it on their balance sheet as an aggregate, instead of having to deal with a dozen of individual conversations about individually managing each asset. They manage their residual share of the exposure that they own, and they aggregate that at the portfolio level. So as I mentioned before, every partnership and every asset can have different objectives, where the portfolio sponsor or the asset sponsor can have one single objective. So if they aggregate everything there, they can pick and choose what they want in terms of risk exposure and properly manage there by avoiding having to convince 10 different tax equity partners of getting on and modifying the risk mitigation solutions they have in place right now. So, and we also think that the daily routine of asset manager needs to include daily and hourly decision making in order to mitigate market conditions as they are happening. So that's the biggest difference from what we proposed and what's being done right now, is that there's an accountability and responsibility for market performance of the assets that resides within the asset manager. And if you flip to the next slide, I think the asset manager's job is to find the proper balance between risk management and asset optimization. As I said earlier, there's not everybody has the same objective, and not every projects are in the same condition as well. You can have a poorly contracted asset that is going to have a really different objective than a very favorably contracted asset. So you need to be able to find the right balance and to be able to use the portfolio effect to make an optimal decision and minimize the cost of operating those assets. So the main job of the asset manager of the future, I think, is to maximize portfolio value and manage the projects and portfolio IRR. And it's not just an energy delivery onto the grid like we've seen in the past. Finally, if you flip to the other slide, we also think that the toolbox of the active manager is a lot more complete than the traditional asset manager. And usually I like to do a kind of a construction analogy for that. You can hire a plumber to do some plumbing work at your house, but if you ask them to do electricity work in the kitchen, he might be able to do it, but it might not be as good as if you ask an electrician. So a general contractor will have many tools in his toolbox. He's going to have access to the right professional for the right job. And that's a bit who we are, where we have access to a lot more market instruments, we have access to a lot more tools, and we have that optionality that, as an active manager, allows us to better manage risks on behalf of project sponsors at a much more lower cost than if they had to do it on their own, since it's a different business. So we think that that's the way of the future, and the day-to-day is going to have to use a bunch of market-ready products like virtual bidding or physical flows or financial contracts to deal with volumetric and price risk, and FTRs up to congestion and point-to-points that are all market-ready products to deal with congestion. And that those decisions, they happen on a daily basis and on an hourly basis, and it becomes much more dynamic and active as a market function than traditional asset management. So I'm going to end my presentation by saying that asset owners and project sponsors, they need to expect more from their asset management. They need also to take control of their assets, and it's time that they choose wisely in whose hands they put their assets in going forward. And as we continue building renewables and the intermittency of the grid increases and eventually gets mitigated by batteries, the asset management job is going to be a very active one. And it's going to be a sure dynamic that we're ready to face. And I'm sure the rest of the market is going to follow as well. So that's me for today.
Thanks,
Elaine.
Elaine. That's great. And we do have a question for you in the chat here, but we'll get to it at the end if that's okay. But if you want to read ahead, go ahead and read ahead, and you can.
I will cheat.
Cheat. Okay. Our next speaker is Kieran. And Kieran, also let you introduce yourself there and give a little bit more of an overview.
Sure. Hello, everyone. Thank you, E4 Carolinas and CR Partners, for the opportunity. Very good morning, good afternoon, wherever you're joining from. Good evening. My name is Kiran. I'm a technologist. I've been in the technology space for about 20 plus years, predominantly serving financial services companies on the buy side, sell side. As a technologist, I get excited when technology solves business problems, and we see an impact for the top line and the bottom line. I'm here to talk about blockchain, more specifically how the sector that we are focusing on today can eventually look at an entirely new revenue stream and how people are reacting to the opportunity or the market opportunity that is out there today. I've been in the blockchain space for about 4 or 5 years now, predominantly on the enterprise side and more recently on the decentralized crypto side of things. Started a few companies, but also teach at Columbia University on the topic of blockchain, and I'm excited to cover a topic that I think is of very pertinent detail for you today. So next slide, please. The topic that I'm going to be discussing in the next 10 minutes is that little paragraph there, how currency or crypto mining rather can be a net new diversification strategy for you all in the segment. Elaine actually helped me and laid up a very good conversation. If you heard him, he said he and his entire company is into active portfolio management. And one of the things he's touched upon is volumetric risk and how companies and their own company is giving clients exposure to financial futures, financial power derivatives, and so on and so forth. And what I'll be talking about in the next 10 minutes is really for you as players in the ecosystem to really seize the opportunity of actually being the farmers or the miners of these natively digital financial instruments, which I personally see being incorporated into some active strategies that Elaine was talking about before. So the way I've structured the conversation, I'm using a color-coded system. Anything that you see in nice and green is a general text, but anything that I want your attention is in red. And of course, an opportunity for you is the third color there. So next slide, please. I'm covering this topic, normalizing the understanding of the topic itself, assuming that most of you are just coming to consensus with the topic or learning the topic, though I would expect some of you being way learned and informed than even myself. So please pardon the basics or a high level overview. Just want to convince the entire crowd on what the promise of this opportunity is. From a blockchain and a basics perspective, what we're looking at is a system of storing something of value. Historically, that something of value has been denominated, as you know, in gold, in currency, and now we're talking about digital currencies. And with respect to gold as a denominator of store of value, you know everything about how we get to mine gold, and you know the same thing, or rather I'm assuming that you know how we mine or mint currency, in this specific case US dollar. With respect to digital currencies, which we're focusing today, the mining is no different, right? There is something called a mining rig, and the mining rig is a coming together of 4 distinct components that you see on the right-hand side, which is compute, power or electricity, connectivity, and of course, some patience and time to get to where you want to, or in this case, mine the digital currency. Of course, software is a big play, but that is assumed to be part of the whole mining rig itself. The mining economy, which comes from this basic technical detail, is really 2 different players today, which is consumer grade, where you and I can participate in this economy from the comfort of our home using our own computer, if you have the skill and the capability. But what we're really discussing today is how power and energy companies, given they are in the business of producing one of the quintessential elements to mine the digital currencies, which is actually the most prized cost factor in the whole mining process, which is the electricity itself, how they can support commercial grade mining opportunities and really seize the current opportunity that is in the market to actually participate in this new digital economy of creating, cryptocurrencies or digital currencies. And what you see on the right-hand side is where I would like to draw your attention. The opportunity is really twofold. One, catering to the electricity needs of commercial grade mining operations, and also reaping the benefits of monetizing on the digital assets that come out of the mining process. Next slide, please. Still, we're talking about the basics. So the demand in the ecosystem is really the viability and adoption of a cryptocurrency ecosystem. Some of the cryptocurrencies that you've heard too much in the news is the Bitcoins of the world, the Ethereums of the world, the Solanas of the world, and so on and so forth. The rate at which consumers adopt these ecosystems is where the demand is coming from. The supply for those ecosystems is coming from the capacity that a mining operation can bring together to actually mint these digital currencies. And I don't want to go into the detail of or intricacies of how you go about mining itself. It can be proof of work, proof of stake, or if it's proof of stake, you have capacity to be a validator node. At the end of the day, you're offering compute capacity at scale in a commercial manner. And the more you do it, the more the consumers adopt this digital and crypto ecosystems, you need more of commercial grade electricity at a very competitive price, and that is your opportunity. Next slide, please. One stark difference that you're looking at today, unlike other opportunities that you've chased in the past, being in the business of mining, whether it's oil and gas or gold or even minting currency, is the last row in that matrix, right? Traditionally, if you mine oil and gas or gold, the input, I don't want to talk about it, you know everything about it, and that's my assumption. And the output is really a tangible commodity, right? And the way you package or deliver it is digital is just a representation of that commodity. And Elaine touched upon it, right? So how active portfolio management is done, how these commodities are packaged into financial instruments. And most of the business systems that tend to identify these commodities are an indicator or a representation of the actual tangible commodity. And the same is the case with gold, and same is the case with the US dollar itself. But with mining, it offers an immense opportunity to actually position or take the output of the mining process and directly inject into the digital ecosystem, where you can package it, deliver it, and track it natively digital. There is no secondary representation, and that is very promising. The next slide, please. So we got 2 more minutes. I'll try to wrap it up as soon as possible. Next slide, please. And to summarize the opportunity, you're looking at 3 different opportunities. One, to really power these mining operations from a steady point of supply at a competitive price. Take ownership of the output in a digital format readily, which is the digital currencies itself, and participate in the trade life cycle of the entire cryptocurrencies from the point of origination. Next slide, please. Why now and why not 5 years ago? And the answer is the slide here, right? Predominantly, the mining operations globally are spread across those 10 countries that you see here. More recently, in the last year, there was an event in China, which actually drove the entire mining capability out of the region and into countries like ours and beyond. And I would like to point to that arrow where you see that blue bar. The blue bar is the total mining hash capacity that miners from China were, delivering. And almost in a 1 to 2 months time frame, you see that shift in the landscape going from mainland China to our own country here. And that is really our opportunity. And the last slide, please. Some of the activity has been already picked up. You've seen quite a bit of news. If you haven't, some highlights I've pointed here. Texas, where 2 big companies are, fighting it out. It so happens they're repurposing an old aluminum refinery, project for getting the mining started. And the news is all over the place, right? So, and next slide, please. In our own Carolinas, South Carolina and North Carolina, both have very sizable representation of blockchain activity, right? And which have come together around those 2 organizations. Take a look at them. And with that, I'll end my time or conversation with that note, right? The next generation data centers continue to power the digital transformation and cloud services of the world. The next generation mining operations could possibly power the digital assets and economies of the future. And this is your opportunity to participate. Thank you.
Thank you, Kieran. Appreciate it. It was great. Okay, Justine, who's with Sia, worked with her in the past here from Houston. So we're excited to hear about crypto, future of energy. So Justine.
Okay, thank you very much. And hi, everyone. So could you please move to the other side? Joe, please, could you move to the next slide? Thank you very much. So before starting about the topics, a few words about blockchain and crypto asset capacity at SIA. So we are a team of dedicated experts. We are 20 around the world, mainly based in Paris, but we work worldwide. And we have 360-degree services for your needs. So we go from strategy and of course training. We have a lot of demands about training to technological implementation. We have engineers on the team that could develop a smart contract and product from start to end. We also have a security part, and we propose additional services about communication, creating a crypto fund, or creating a crypto mining company. So could you please go to next slide? Thank you. So let's talk a bit about crypto mining that can, as Kiran explained, it could really offers opportunity for every kind of energy supplier, from hydroelectric power, wind power, solar power, and oil and gas. In fact, all those energy power have a surplus. So what is interesting to do, and that we help company doing so worldwide, is to monetize this surplus of energy, which help to reduce induce energy losses and also to diversify the activity. And it's a thing that you can do even in country in France where the network is very efficient, but sometimes you have, for the flexibility of network, to turn off some power energy. So it could be interesting to mine crypto instead of just turning the wind power or the solar power off. So could you please go to the next slide? Thank you. So this is a few arguments. So why mining crypto for oil company could be a profitable opportunity, but also a way to meet ESG goals, because the challenges with net zero scenario by 2050. So if we look at the challenges, we have 5% of the global gas production that is flared annually. So it's 400 million tons of CO2 that are projected in the atmosphere every year. So that's a lot. It represents 8 million tons of methane, and methane is much more harmful than CO2. The solution could be to use this lost energy to mine crypto, especially Bitcoin. And with this, countries could earn up to 82 billion. And Bitcoin mining could avoid as much as 2/3 of methane emission. So there is plenty of advantages. Could you please go to the next slide? Thank you. So with all those figures and the fact that it's a very, how to say, profitable activity, on our side as SIA partners, we have an increasing demand of companies that want to launch a Bitcoin or crypto mining activity. We have a lot of demands, especially right now in the Middle East. And here I am going to talk about a sovereign fund that 3 months ago asked us to launch a Bitcoin mining activity. So they had a lot of capacity because they had 600 megawatts. So they had already the partnership with the energy providers, and they already had the location. But they wanted us to help them in order to build the company, so the legal structure, and to design the farm. It's a very beautiful project. We are still doing it. So here I put you the big part, in fact, of the mission. So first, we started by doing a big benchmark and analysis. We contacted plenty of competitors, which are in fact, very nice, and they welcome new actors quite nicely, to be honest. So they talk freely to us, and we got plenty of information. Then we designed the organization. We designed the farm, and then we start building it. We are really at the start, because when we design the organization, we also need to hire people, and this phase is not finished. So that was for this mission. Could you please go to the next slide? So first I talked about crypto mining, and now I'm going to talk about blockchain, but mainly without blockchain without Bitcoin. I mean blockchain, the technology. Here I propose you an overview of main use case we can find. So I divided them into 3 categories. So the first one is certification. So it means emitting green certificates, carbon credit certificates, doing the traceability of hydrogen to see if they are really green and not more darker hydrogen. Then you have the asset exchange use case. Here it is when people want to trade in a peer-to-peer way energy. Either it is energy they produce or energy they have. We also have green certificates trading, carbon credit tradings, and tokenization of renewable energy plants. That means, in fact, divide into, create a kind of digital twins of the plants, and be able to, through the token, to see the evolution of the life of the plants. And third category, the automation part. So here it's about, we can see a kind of IoT security. For instance, it is IoT on wind power. We are working on a network flexibility automation with blockchain tools that I will detail after. There is also automation for recharging electrical vehicles, everything about billing, and of course about oil and gas trading. So this is the overview. And right now I'm going to present you some return of experiences of projects we made on those categories. So could you please, Joe, go to the next slide? Thank you. So the first return of experience that I want to talk about is the one about a decentralized platform to trace carbon credits. So it is a very complex project where we want to use a blockchain to trace the carbon credit from their creation. So the idea is to be able to estimate on a part of land the amount of offset carbon that is produced, to tokenize it. To make it more fun, we tokenize it through an NFT, and the NFT is the little card that you see. But that is because we gamified the project. And so people could buy on the primary market those NFT which are offset or credit carbon offset, and they can trade it also on the secondary market. So here I put you the way the carbon credits are validated. So we can go through it. How does it work? So first of all, a project leader that has a land propose a project to the blockchain administrator, to say. And the validator, here it is, we worked around a decentralized autonomous organization, but no need for me to, I think, to go deeper on it. So once the project is validated by the whole organization, a NFT representing, so it's a token representing the share of the project is put on sale. Then what is more, periodically the validator audits the proper functioning of the project, but that is a functional things. What is more, an independent organization certifies the carbon credit generated, because it's here we were working in Ireland and it was quite regulated. So there is organizations that audit those things. And when credit carbon are generated, they are registered on the blockchain in the form of token, and these tokens are then paid out to NFT holder. So in fact, you have the NFT represents a portion of land, and this land is offsetting, sorry, credit carbon, and those credit carbon are represented by tokens. So the use case is quite complicated, but the idea is to make it very simple for client and buyers. We are right now working on the technical part, but we made all the white paper and the first step. So that is a project that SIA made from start to end. So, and it was about carbon credits. So could you please go to the next slide? Thank you. And the other use case, the other project that I want to present to you is a return of experience of a blockchain solution that we are making for network flexibility in France. So that is to say, it's using a blockchain to how to say, to optimize the network flexibility. That is to say, sometimes we have to turn off some plants, especially wind power, when there is congestion on the network. And this was quite hard to follow when how to say, when a producer received the ask to turn off the production, and who gave the order, etc. And here we are trying to set up a whole blockchain solution to follow this. So it's a huge project of several years, and here the technology blockchain brings a lot of opportunities and solve plenty of pain points. So I think maybe I'm done with my time. So if you have questions, feel free to ask.
Thank you, Justine. I just was hoping JC could pop on and introduce himself quickly, and then I see a number of questions in the chat. I think, Alain, you have 2, so, and Justine. But JC, would you mind introducing yourself real quick?
Yeah, please, sure. Thank you for having me. So I'm JC, I'm the founder of ODLNG, Blockchain for LNG. We incubated the company 2 years ago now in Tallinn, Estonia, and we are focusing, as you said at the beginning, on the LNG industry. So thank you again for having me. I learned a lot. And quick comment from what I've heard from the three speakers, it's really echoing positively with what we've heard here in Europe about the three major issues that we heard from the energy industry: decentralization, digitalization, and decarbonization. So thank you again for the three speakers, because I learned a lot of things, and happy to discuss with you all. Thank you.
Thank you, JC. Okay, I'm scrolling up to the top. Alain, your first one that you maybe got a minute to think about, if you could comment on issues with accounting auditing firms, and have you seen anything along those lines?
It's a conversation we've had with ours. I think it's still a pretty obscure area where they're still scratching their heads on if those are considered derivative or not. And I think the general lack of liquidity is making this conversation really difficult, because to the eyes of an auditor, it becomes quickly a level 3 pricing. So you need to have an internal modeling, and you need to source that. So it becomes very complex if you're trying to model the grid 2 or 3 years out. So the closest thing you got is mark to auction, which is also very dependent on the level of activity that you have there. So I think it's a work in progress. As people move into the space and liquidity picks up, I think you're going to get clearer definitions of what those things are. But we don't get questions from our customers from that, but I'm just speaking out of experience here. So if any other guys on the panel has any more comments, I welcome them.
Kieran, I don't know if you had a second prep for this one, but IT, helping organizations, etc. Cryptocurrency, the rapid growth of crypto. This might be a good Justine/Kieran question here.
Yeah, I can take a shot at it and let Justine chime in as well. Really, it's a software play. So Neil is a person who asked the question. So it's a twofold approach, right? So one, at the heart of the crypto mining or the cryptocurrency mining or the whole Web3 revolution, we still have software at play. So if first it means that your IT systems have to be repositioned or upgraded to the current demand and need. Point number one. Point number two, how can IT help organization mitigate the energy issues with growth in cryptocurrency? Is really, it's a balancing act, and the balancing act comes from the very nature of how cryptocurrency mining is truly decentralized, as in you really don't necessarily have to have all your investments made in one data center close to an energy provider, independent of where the source of that energy is coming from, whether it's renewable, oil and gas, and so on and so forth. But the point I'm trying to convince you and answer your question is, cryptocurrency mining is a decentralized capability enabled by modernized IT systems. The IT systems itself can be intelligently located at a place where energy can efficiently be drawn from a source, and the mining can operate closely and almost move synchronously where the best source of electricity is available. So it's not a static operation. If you plan it correctly, you can literally have 4 locations strategically for mining, and you can ramp up or ramp down mining operations at a certain strategic location based on the energy consumption model that you're subscribing to. And I hope that made sense. Thank you.
Yeah, I think JC, I'm going to give you one here too, which you can probably read there around blockchain technology. I think somebody read ahead on your bio and thought this was a good one for you, so I'm going to pass this one to you.
Can I make a quick comment on what just Kieran said about the IT? Yeah, just a quick follow-up, because Kieran mentioned a very strong point during his presentation, because he mentioned different roles. And when I heard IT department, they could consider that they can play different roles. Blockchain is an ecosystem. It's just not only mining. Having said that, they can play some roles as a node through the chain. They can play the role as an oracle, as Prihan mentioned during his presentation. So what I'm saying by that is that there is so many different roles that an IT department can play for a very advanced or very mature chain, but most surely for new chains that's coming up. So it's just what's a quick follow-up on that. Thank you.
Okay, I think Justine, growth of crypto market. I think everybody is asking this question generally, adoption, etc. And where do you see that going?
So I've been working in crypto / blockchain since 2016, and what I see is that crypto is clear. The growth of crypto market is is moving very fast, is accelerating right now. First, the trigger was Libra of Facebook. People started to think more about crypto. Then there was the COVID crisis, and this really opened the door to the crypto world. And now we are talking about crypto topics and decentralized finance to top management of society and huge society. It was something we would never have done a few years ago, or even a few months. In France, we are working with the French central bank, and at highest level, they are talking about crypto, so it's moving very fast.
Got it.
And of course, the adoption will influence the energy industry. I think especially because more and more energetician or company in the energy field are considering crypto mining.
Yeah. We worked on a project related to that too. So Elaine, I'm going back to you, and then JC got one for you, and I think Jane can see it. So Elaine, I don't know if you can see this one. Where can IT innovation make the biggest impact on the decision-making side or the integration to the grid side?
It's like you're asking me to pick between chocolate and ice cream.
Both.
I'm not sure which one I like best. So, but I think both are important. I think that in order to do some decision making, you need to integrate with the grid, and there's been a severe lack of innovation on that front in the past, let's say 20 years. So I think integration needs to happen. I think we need to modernize most of the ISO's system. We need to modernize how we interact with them, whether it's it's been a real-time market for quite some time, but it's 5 minutes interval, so it's real-time to some extent on the SCADA services. But when you get to batteries and even cryptos, when they qualified as controllable load and all those distributed energy resources that are going to be aggregated under FERC Order 2222, I think you're going to get a lot more actual real-time interaction with the grid. And I think that infrastructure needs to be modernized, and there's a severe need for innovation there. That being said, all those real-time assets are going to need management, and they're going to have you're going to diminish the time you have to make a decision. And once that happens, you're going to have to do it in a much more automated way. So you need IT innovation there as well. And if you allow me to add one last one, I think cybersecurity is on the forefront of all those conversations as well, especially given what's going on with Russia and all that stuff.
Yeah, great. Let's see. I think look here.
I think there was a question there for JC around differentiating a commodity that's fungible with unique characteristics, non-fungible, and specific attributes, as ESG parameters, green certificates, What are your thoughts there on how that can be valued?
Okay, indeed. Thank you for the question. Fungibility in the blockchain industry, it's at the core indeed. And what we see after that, I will explain what we develop. But what we see, for instance, for an oil and gas company, if they want to invest in the mining activities, some of them they said, yeah, we can reuse some renewal to mint, to issue some, let's say, green Bitcoin or green tokens or green coins, and the complexity of that is you transform something that's fully fungible, that basically you can exchange it for the same value with the same characteristic, and you turn that into something non-fungible. And that's interesting when Justine mentioned that the program, the project that she was working on, and when she mentioned the NFTs, the non-fungible tokens, this is the issue of that. And to address more specifically this question, this is something that we are working on actively with ODLNG. The way we can integrate or we can create a digital asset or token, name it the way you prefer, and to integrate some specific characteristics, some specific attributes, namely, as it is in the question, ESG parameters, ESG values, green attributes. And with ODLNG, for example, the way we do that we create what is indeed an NFT, and then we have the possibility to characterize this NFT and to modify some characteristics through the lifetime value of this token, again to reflect the efforts that an oil and gas company can make, and indeed at the end is again to prove that for instance, in the context of the natural gas industry, the gas molecules, at the end, it will be the same. It's still fossil. The carbon footprint is quite heavy. But the way you can characterize some effort that you make to mitigate this carbon footprint, or the effort that you make to have, let's say, a social acceptance when you operate in your country, all the beauty of this kind of digital asset or NFT, or name it the way you want, that they can reflect these efforts, and you can transform a molecule of gas that is fully fungible, but you put on the top of that some metadata, and you turn that into a non-fungible thing with, as I said, some specific characteristics that you can demonstrate that you operate safely, socially accepted, or environmentally beneficial. So this is the way I can answer this question. Thank you.
Thank you, JC. Kieran, I want to call you back here to the group. And this one's for Justine and Kieran. Kieran, maybe we hear you, then we can move over to Justine. I don't know if you can see it. Can NFTs be minted in energy efficient networks? If yes, what are those networks?
Khalil, yes, thanks for the question. Thanks, Justine. Yes, the answer is it boils down to the consensus mechanism employed by the underlying ecosystem itself. Given that some of the ecosystems employ very energy efficient consensus mechanisms, the simple answer is very much so, absolutely. And there's a big push around ESG and energy efficiency being the name of the game with respect to employing the credibility of a consensus mechanism of a decentralized network. Now, a few examples to quote: Ethereum itself has an excellent ecosystem of NFT enabling capabilities, layer 2, layer 3. Some examples of ecosystems: OpenSea, Rarible, Forge, and those are the three at least I could think of. Hopefully that helps.
That's great. Justine, if you have any thoughts on this, and then I'll let you wrap us up. We have a couple more minutes, but that question, you can cheat on that one too. But Justine, any thoughts on that question?
If you, in terms of layer 1, yes, you have some blockchains that are more, how to say, energy efficient friendly than Ethereum. You have, for instance, Solana or Tezos, and what is more, the fees are are less expensive than on Ethereum. So it's a win-win, win-win, how to say, solution.
Okay. Lynn, you see that one? What do you believe is the most influential factors, et cetera? ESG.
It's an interesting one, that one. I think it's two things. First of all is the investors' actions. I think it used to be a 2-factor decision making where they optimize risk reward. Now it's a 3-factor decision making, risk reward and carbon footprint. So if investors starts to make investment decision based on those 3 criteria where they are going to favor a more carbon friendly asset or investment for the same risk return relationship, I think we're going to get there. And the second part is customer behavior as well. You know, if you start thinking and have that mindset where you're going to try to get educated and buy from source that are greener or more sustainable, I think that's when you drive business. Like businesses, they want to keep your business, they're going to make some changes. And eventually you're going to see that ecosystem kind of evolve towards a more ESG friendly setup. So that those I think are the most 2 influential. So the investor and customer behaviors.
Okay, thank you. I'm just reading through here to see if we have any others that you haven't answered yet. Doesn't look like it. There's some others. I'm sure we could go on for a long time on these questions. Shane, can I flip it back to you?
Yeah, definitely. Such an interesting topic. And like you said, we could go on forever. Really want to thank our panelists for presenting today on this topic around future of energy. It was really, really interesting. I did plug into the chat. Someone had asked to know how they can know more about SIA Partners. So there's a link there. And also my email if you want to reach out directly and ask specific questions. Appreciate E4 Carolinas for allowing us to sponsor this today. And with that, I'll hand it back over to John, who is going to help close us out.
Shane, thank you very much. And let me echo the appreciation to our speakers for a very interesting topic, and Sia for helping put this together and to host it. For those that are interested in all things digital, there will be additional workshops and webinars coming up. Let me encourage you to frequent the E4 Carolinas website, where all of those upcoming events are noted, and you certainly can register for those, as well as others that we have there in addition to the topic of digital matters in energy. And with that, we will finish up. Thank you all very much. Hope you have a good rest of your day.